Alrighty, guys, let's react.
Tech space, SoFi CEO Anthony Noto. Welcome back, Anthony. It's good to have you. What are you seeing on the delinquency front?
Well, Sarah, thank you for having me, and I appreciate coming on there. In terms of consumer activity more broadly, and then I'll talk specifically about the credit card business, consumer activity and sentiment is trending okay. And I think as long as the Federal Reserve cuts rates 25 to 50 basis points, that trend will continue. A couple of data points that we're seeing that should be instructive for the audience is what's going on with the SoFi member. Again, a SoFi member is a higher income member, higher credit, but it is indicative of some part of the market. We're seeing debit spend.
So that's very important right there. He basically categorizes SoFi customers as higher income and higher credit scores, right? And I think that's very important because SoFi, they price this stock. Where do they price this stock? They price the stock like it's like going to be like a BK. It's a bankruptcy risk type company in a recession, right? That's the way they price it. I'm just going to call it the way I see it, right? I mean, the stock's been fluctuating between $5 and $8 for a while now. What other bank stocks are fluctuating around $5 to $8, right? That's basically Wall Street kind of saying, oh, you're a big risk. We don't know about you because we know the growth is there, right? Do we not? Like the growth is amazing at SoFi. And Anthony knows, like, you guys realize, like, we're higher up the rung than these other banks in the loans these other guys are providing, but you're going to value us at these joke prices, right? So I think that's something very important to kind of keep in mind here because, yeah, man, the SoFi valuation is pretty comical.
To be very strong. It was strong in Q2 and continues to be strong in Q3. But importantly, that debit spend is not coming at the expense of deposit growth, which also remains strong. The second data point I would share with you is in our invest business. We saw about 50% growth in net flows in Q2 in our assets, in our invest business, with a lot of interest in alternative assets, which we launched at the beginning of the year, but diversified investments like ETFs and robo. And we're seeing strong net flow growth again in Q3 as well. And then on credit cards, to your specific question, our portfolio is quite small. It's growing nicely. We are seeing improving entry rates into delinquency. We cited in Q2 that we saw a 20% improvement in entry rates into delinquency compared to 2023. And we're seeing continued credit performance trends in line with expectations in Q3 in credit cards as well as personal loans, which is a good outlook.
So when you see the market throw a big fit like we saw yesterday on worries that maybe they're not pricing the recession as much as, say, the bond market, what do you think? It doesn't sound like you're seeing any kind of big red flags.
Well, I'd say two things. One, we do have a higher income customer, and they also are higher in credit, so they're not going to be fully representative of the broader market. A subprime customer would be experiencing different trends, and even middle America would be experiencing different trends. But I do believe what we're seeing is a piece of the puzzle. If we don't see Fed action of 25 to 50 basis point cuts, then the concerns on the macroeconomic front will become a reality and we will go into a recession. But I think the Fed understands the importance of the cuts that are coming. I hope they move with 50 basis points. It gives them more optionality. It'll be more impactful to corporate America, and it will definitely.
Thank you, Anthony Noto. We are on the same exact wavelength, are we not? Right? I've been telling you guys they need to come out, do a 50 right off the bat here, do another 50 at the end of the year, get us down 100 basis points, and then we'll see where we go from there in 2025. So we're on the same.
More impactful for the consumer. And I think waiting to move that amount could be taking more risk than is necessary, given where unemployment is trending and given where we're seeing things like Jolt's report today.
Hey, Anthony, it's Carl. This week, the journal.
The gap between Fed funds rate and the CPI, it's a ridiculous gap there. I mean, it's insane.
On Americans and how good, the journal argues, they're feeling about their 401ks. We've seen the number of $1 million 401ks at Fidelity. I wonder how you think your consumer is thinking about their equity gains and how reliant they are on this so-called wealth effect. What would happen, for example, if we had a severe correction?
That's fair.
Yeah, so far, we're not experiencing spending due to a wealth effect. We're seeing spending based on income. Debit spending and deposit trends are the first indication of that. If asset growth slows, then we'll, in fact, start to see some risk in debit spending and deposit growth. But right now, asset flows have continued to grow as people have gotten good returns, both in their 401k and their discretionary investing as well. So think of it as a ladder effect. First, net flows will slow and go negative, and then you'll see a decline in deposit growth and then a decline in spending. And right now, we're actually seeing an improvement in net flows, improvement in deposits, as well as spending.
So I don't know how anybody could walk away from watching that interview and not be insanely impressed by what SoFi is doing, what their business model's up to, and just very impressed with Anthony Noto. He's ready for every question. He's going to explain to you exactly what's going to happen, what's going to transpire, why it's going to transpire, right? I mean, that's top tier stuff. And I mean, other than Jamie Dimon, I got the most respect for him of any buddy really in the banking system right now. Lloyd Blankfein, who used to be at Goldman Sachs many, many years ago, I had a lot of respect for him. He's long gone from Goldman nowadays. But phenomenal, man. I mean, it's hard not to be a buyer of SoFi stock, right?
Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you're looking at in front of you right there, that's 1000xstocks.com. That is my personal advanced software that I use to make my investment decisions when I go to invest in companies. As somebody that's been in the market 15 years, I got sick and tired of using these different services that folks have out there that are designed for traders in the market. People that are looking to get in and out of stocks. That's not what I'm here to do. I'm here to long-term invest. I need to be able to see all the different ratios and metrics that are very important for me as a long-term investor to judge if I'm getting a great deal on a stock or if I'm getting ripped off on a stock. I need to be able to compare different companies versus each other and be able to do that in a matter of seconds rather than it taking hours like it used to before I created this service. I want the ability to listen to conference calls, see SEC filings all in one service. That is what we've created with 1000xstocks.com. If you are looking to access this software, go down to the description area of this video. You can click the link down there and apply for access. If you don't want to do that and you want to search a website, go to 1000xstocks.com. Enjoy it.
Next one up here, 3-stock lunch, Target, ExxonMobil, and TopGolf.
3-stock lunch today. We asked our trader to check our teams and see which ones he loves or hates. With our trades is Boris Schlossberg, Managing Director of FX Strategy at BK Asset Management. So first off, wide receiver pick, Target. Boris, what's your trade on Target?
Love Target. Target, I think, is back. It's the preeminent merchandiser. I mean, it's the only place in the world where you can go for a half gallon of milk and come back with 3 outfits and a pair of slip-ons you didn't know you needed. They've done a couple of things I think are really, really good right now. They have really improved their logistics. They've improved their digital commerce quite a lot. The app is working really well. And they went to private label brands. I bought like 5 button-down shirts. Love them. I think you probably will love them too, Don. So I think Target has bright future ahead of it. They're back in business. Love the trade.
So of our whole list, you like Target. You also like ExxonMobil, Boris. Why this one? Energy has not always been, especially this year, the best trade.
Yeah, I think this is a widows and orphans stock. Great company. I think ICE is here to stay. As much as EV has evangelists for it, I think ICE is still here for quite a long time. And ExxonMobil is obviously predominant sector leader in the energy space. They've done really, really well. They're doing $1.3 billion out of the Permian Basin right now. The market is very excited about their Guyana development, which has 11 billion possible recoverable barrels going on. All of this is really good relative to the fact that we have all this tension in the Middle East and Russia. So I think they're in a very strong shape.
All right. And
let's go ahead and pull up valuation on Target and ExxonMobil. Alrighty, looking at 1000xstocks.com, compare feature here. Looking at trailing 12-month PE on Target, just under 17. ExxonMobil's a little under 15 here. Forward PE on the baby is about 13 versus about a 17 on Target. 2-year out forward PE is about 14 on Target. ExxonMobil's about 11. I always say both. I like both. Target and Exxon. That doesn't mean I'm going to buy these stocks because there's much better opportunities out there than Target and ExxonMobil. But what I'll say is I like both of these stocks. I think both of them could be money makers over the next few years. Earnings per share growth expected to be very strong for ExxonMobil. Don't be surprised if oil price comes back, I would say fairly strong next year and into future years as well. So I actually like ExxonMobil pretty decent here. So, and Target is a really good name. I always like Target. So, yeah, no, not bad. And then let's hear about TopGolf.
It's my kicker, TopGolf Callaway brands. It's the one that we want to talk about. What's your trade on TopGolf Callaway?
Sorry, Dom. It's buying the catching knife. I think golf is a disaster right now. They're facing a lot of macro headwinds. They've got it down quite substantially. A lot of people maybe want to buy it as a because I think all the bad news is in it. I don't think so. You need to wait a little bit to see if golf kind of recovers. Golf also has a lot of competition now. Pickleball on the up end, and extreme sports and video games on the lower end. So it's kind of hard to get motivated on the macro side for golf. So I think they have a lot of problems ahead of them. I'd rather wait and see until they recover before you get long.
I hope
that
you're
stock.
right, Boris.
Okay, interesting. Yeah, TopGolf could get interesting. So let's imagine a scenario here. I mean, could there be a scenario where TopGolf goes down to $1 or $2 and starts pricing in bankruptcy? That could happen. The way that could happen, essentially, imagine unemployment rate starts to really tick up like crazy in 2025, right? And all of a sudden everybody's like, oh, the recession, it's hitting, it's here. The Fed's not lowering fast enough, and next thing you know, it's ugly. We know we'd get a major sell-off in the market. And stocks like TopGolf would get sold exceptionally hard in that sort of situation. Additionally, people would start just flooding out of anything that is seen as higher risk, higher debt, anything that people would feel like would need capital infusions, which, you could put TopGolf into that sort of, bracket, that sort of conversation. And next thing you know, stocks all of a sudden down to $1, $2. And then maybe it's worth a flyer at that point in time, right? It's kind of like just a crazy risk reward. It's like if it doesn't go bankrupt and they make it through, I mean, my gosh, and they get back to a $10, $20 stock and you're buying at $1 or $2. I mean, that's pretty crazy ROI, right? And so it could be worth like a 1% position or a 0.5% position. So in some sort of scenario like that. So I don't know, we'll see what happens there, but it is one to kind of keep an eye on. And it's one that could end up being really, really attractive if things went really south in the economy and the stock just got absolutely wrecked again.
Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you're looking at in front of you right there, that's 1000xstocks.com. That is my personal advanced software that I use to make my investment decisions when I go to invest in companies. As somebody that's been in the market 15 years, I got sick and tired of using these different services that folks have out there that are designed for traders in the market. People that are looking to get in and out of stocks. That's not what I'm here to do. I'm here to long-term invest. I need to be able to see all the different ratios and metrics that are very important for me as a long-term investor to judge if I'm getting a great deal on a stock or if I'm getting ripped off on a stock. I need to be able to compare different companies versus each other and be able to do that in a matter of seconds rather than it taking hours like it used to before I created this service. I want the ability to listen to conference calls, see SEC filings all in one service. That is what we've created with 1000xstocks.com. If you are looking to access this software, go down to the description area of this video. You can click the link down there and apply for access. If you don't want to do that and you want to search a website, go to 1000xstocks.com. Enjoy it. Expect the tech trade to continue moving higher in September. Gene Munster.
I want to do it with Gene Munster, Deepwater Asset Management managing partner. Good morning to you. Gene, we've been on quite a wild ride when it comes to the NASDAQ and some of these tech stocks. I think there's a question about, given where some of the big tech and AI stocks are right now, whether you're a buyer, whether you're a seller, whether you're a holder.
Andrew, I am a buyer here. I continue to believe we're in the first stage. This may be hard to wrap many heads around. First stage of a 3 to 5 year bull market. There is a headline in the Wall Street Journal today talking about the market is really, really optimistic right now. And I believe we're still just beginning. That typically is a negative sign when you start to see headlines like that. But I do believe, Andrew, that we're going to continue this. And I think September is going to be just an important step towards that 3 to 5 year bull market. We got, of course, what's going to happen with Apple next Monday. This is the biggest event for Apple in over the past decade, I would say. Second, I think there's going to be a changing view of what over the next month over how investors view Nvidia. And last, of course, we have Tesla, the October 10th event. We're going to get some anticipation around that. I think when you put those three kind of cornerstone elements together, I think you're going to continue to see the tech trade move higher in the month of September.
Okay, Gene, let's talk about those three names, though. Let's start with Apple. And there is a view, I think, based on the 30% move on this stock since May, that there's going to be a
Nvidia just hit down 9% now. Jeez.
Cycle style buying pattern around the new phone. Do you believe that this year is that? Do you think that gets pushed out to next year? I ask because it's not clear that all of the sort of AI functionality is going to be embedded in the phone and available this fall?
So it's going to be some bumps, some good, some bad over the first couple quarters, but ultimately I believe that this can go much higher. I think if you look at what happened with the iPhone 6 a decade ago, it was up 12%, with the iPhone 5. The iPhone 6 was up 52%. It just absolutely ripped, Andrew. So I think that this can certainly move higher. I think that ultimately, we're going to see this big upgrade cycle coming. And a question I'd have for you, Andrew, is do you believe that that these features are going to be exciting enough to move it higher?
So my opinion is the features are not exciting enough to move it higher. I think the far majority of Apple customers don't care anything about this AI crap. Okay, they just don't. What they are going to care about is the fact that this is going to be the biggest iPhone ever. Okay, much simpler than that. Now, we know every single time Apple launches the biggest iPhone ever, they always do well, right? And so they should do well in this cycle. But there is one thing we all have to factor in, we have to take into account, is a consumer in a strong enough place right now to upgrade like insane? Because I look at Apple right now and I say this should be a booming cycle. The biggest iPhone ever should be a booming cycle for Apple. But then I also think, I'm like, is a consumer in a good enough place to dish out $1,000+ for these iPhones? And so that's where I'm a little like, maybe it's not going to be as big of a boom as it could be, right? Given that the consumer's maybe not in the best place that they were maybe in previous iPhone launches when it was the new biggest iPhone ever. So I don't know, that's just something I'm considering. Don't factor, we're not going to know the true demand for the new iPhone generation in the first like few months it's launched, right? It should have big wait times. There should be a lot of excitement. And that's the wealthier Apple customers that always have to have the newest and greatest. They're all going to buy this, right? A lot of excitement. You know the true demand of these iPhones after Christmas, after the New Year's, and then we get to see, okay, what's the true demand, right? The early people are going to be early. The people with a lot of money, I'll probably order one, right? Those people are going to be out there. They're going to buy it. As soon as it comes out, they're going to be on the website. Boom, 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 right? So you're going to see crazy demand. But don't let that fool you, because we've got to see what the real demand is after New Year's. That's when you find out the true demand of an iPhone.
No, I'm somebody who oftentimes gets the new phone almost every year. I love the products, as you know.
Exactly.
And so, I'm a geek when it comes to this tech. What I don't know is I use ChatGPT and other products like Claude from Anthropic and Google's product as well, and I can do that right now using either their apps or going to their websites. The question is, how integrated ultimately does it have to be into the OS itself? And how, even if it is, it doesn't even sound like it's going to be fundamentally integrated in certain cases, right?
The integration, of course, is going to get rolled over the next year, but I just want to put some context. I mentioned that iPhone 5 to iPhone 6, that massive acceleration in growth rate. And the reason why that's so important, the reason why the iPhone 6 had that breathtaking growth is because it had a feature, the first larger screen that that consumers really got excited about. Yep. In the case of these AR features, you are correct. It's going to take a year or so to roll out. But if they're as good as I believe, I think these are going to be features that when consumers see them, they will view them as must-have. I just want to put some quick...
No, I just disagree with that, okay? Bigger iPhone, yes. These features are going to convince the masses to say, I got to go get the new iPhone. No. That's silly, Gene. Like, come on, man. What planet are you on? But we also got to remember, like, don't think this is going to be as exciting of a cycle when we went from 5S to 6. Because when we went from iPhone 5S to 6, it's very important people remember. At that particular time, Samsung was tearing it up. They were taking market share. Samsung had the big screen smartphones, right, at that particular time. And so if you were around in that era, you know what I'm talking about. If you weren't around in that era, you probably have no clue what I'm talking about right now. It was a huge deal. A lot of people were gravitating towards Samsung because their screens were so big. You pulled out your iPhone 5S. I had a 5S back then. It was like this little screen compared to these Samsungs had these giant screens, which now we've become customary to. But at that time, oh my gosh, they were huge. And so when Apple finally came out with the big screen iPhones, iPhone 6, it was monumental for the company. And their units went crazy. Now, with this new iPhone, it's going to be the biggest ever, but it's not going to be as big of a change. So if you're expecting the unit amount to go up the way it went up back then, don't get too excited about that. Additionally, at that particular time, we hadn't had consumers get hit with inflation the way they had got hit. We had an unemployment rate that continued to drop and drop and drop at that particular time versus recently. Obviously, it's been going up and up and up. So the economy was at a little different place. The consumer was at a different place. iPhones were a lot cheaper back then, also something to factor in, right? An expensive iPhone back then was like $600, $700. An expensive iPhone nowadays is like $1,400, okay? So that's another thing to kind of factor in here. So yeah, it should be an exciting upgrade cycle for Apple, but don't expect it. When he brings up the iPhone 6, no. That was a different time.
Into the sensitivity around the numbers is that the iPhone upgrade cycle, it's typically a 5-year upgrade cycle. If the cohort that is supposed to upgrade in calendar 26, so call it a year out, if 10% of those decide to upgrade in calendar 25, that takes iPhone growth to 15%. The street's currently looking at 7%. I asked the question about, how big are these features? How do you feel about them? I think consumers overwhelmingly are going to embrace these features. It may take a few quarters, but I think you're going to see meaningful upside to Apple over that period.
Gene, I am super excited about it. I just don't know if I'm representative of the common man. I like to think I am. But Gene, here's a separate question. Nvidia, at this point of the ball game, what inning are we in for them?
I think we're in the third inning, and that ultimately I think that there was a misunderstanding of what happened with guidance. They guided up by 2.5% for the October quarter. Previously, when they guided for the July quarter, they guided up 5%. So there's this narrative about this deceleration. But keep in mind that Blackwell slipped. They didn't use that language, but clearly, if you go back and look at the transcripts from 2 quarters ago to the July quarter, it slipped by 3 months. That's $3 billion, they said, several billion. You factor that in, Nvidia would have raised guidance by 12%, not 2.5%. So I think this is still very early. We own Nvidia at Deepwater. We think that it is still reasonably priced at 35 times and can grow faster than what the street thinks next year. And in 2026, ultimately, the risk for big companies not to invest in this is just too high. Nvidia is going to be a big beneficiary of that.
See, that's the issue with some of these more cyclical companies like an Nvidia, right? Is there's a conversation. What inning are we in? Are we in the third inning, the seventh inning, the fifth inning, the ninth inning? It's such a negative conversation, and this is why these stocks have so much trouble eventually. As soon as people start to get a little concerned about where growth rates are going from here and a deceleration, those sorts of things, you don't have that same conversation with Microsoft, right? No one says, what inning are we in with Microsoft? No. You know why? Because Microsoft's one of those companies that you're expecting to grow every single year for as far out as the eye can see. Do we ever have a conversation around Amazon? What inning are we in regards to Amazon? No. Because e-commerce business is going to grow and grow and grow and grow and grow. As long as the economy grows, the e-commerce business is going to grow for 100 years in the future. Okay, maybe not that long, right? But 10, 20, 30 years in the future. If we think about AWS, grow, 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 grow. Their advertising business grow. There's not a conversation around an inning, right? But you look at something like an Nvidia, people say, what inning are we in? And so that's the problem with that. Palantir, you don't have that. No one says, what inning are we in with Palantir? No, you know why? Because Palantir grows quarter in and quarter out forever and ever and ever. And that's the beautiful thing with that. Is Nvidia going to grow quarter in and quarter? No. Nvidia has all of a sudden, they'll have some insane growth, right? Their stock price goes insane. Their revenue goes insane. Their net income goes insane. And then boom, big crash, right? And then a big upcycle, big crash, big upcycle. That's the issue with those companies because people get concerned with timing and ultimately it hurts those companies' valuation over time, right? Which is why you look at Nvidia and you might say, gosh, man, the Ford P looks cheap if you compare it to some other stocks, right? And that's a fair statement. I mean, let's pull up the compare feature here and compare Nvidia versus like a Palantir. Look at Nvidia's at half the Ford P that Palantir's at, right? Now keep in mind, has Nvidia been growing much faster than Palantir has been growing? Yes, factually. But Palantir, we look at that and we say that company's going to grow year in and year out for the next 10, 20 years, right? Nvidia, we say they're going to grow for sure this year more. They're going to grow likely for sure next year more. Are they going to grow in 2026? Are they going to grow in 2027? I don't know. That's the issue. Are we concerned that Palantir is going to grow in 2026 and 2027? No. We all know they're going to grow, right? That's the difference. And that's what's important to kind of keep in mind in regards to stock market, the games Wall Street plays, how these stocks are valued, right? That inning conversation, it sucks for a lot of stocks because they get in that and it just is what it is.